I'm excited to kick us off here on another webinar. Barry Brooksby is with me. I'm Steve Gibbs here at Insurance and Estates. And Barry, welcome.
Thank you, Steve.
So today, really wanted to bring something to highlight the top 5 benefits, high cash value whole life. Barry and I do a lot of webinars together. Barry is our preferred infinite banking practitioner. Our desire is to just help you in this process to bring estate planning and using high cash value whole life in a strategic way to create wealth, to provide for security for loved ones. And so we're going to jump into that. You can see we've got a pretty substantial amount of experience in these areas, and we are striving to bring them together. Our goal is to, number one, we want to discuss these top 5 benefits of what we call high cash value whole life. We also want to talk about how criticisms of high cash value or whole life in general are based on some misconceptions and misunderstandings. Finally, we want to highlight some key concepts, benefits that might be unknown about high cash value whole life insurance, so you can begin to get a picture of how you think this could apply in your situation and given what's important to you. Social proof, people are usually shocked by this. What we mean by social proof is who's using whole life insurance. There's a lot of activity in the world of whole life and high cash value whole life that folks oftentimes aren't aware of.
Steve, I work with clients all across the country, as you know, and I'll often hear people say, well, Barry, why aren't more people doing this? And my response usually is, there are more people doing this than you might think, but we're making it more popular in the mainstream. For example, take a look at these names: Nike, Wells Fargo, Bank of America, Chase Bank, the University of Michigan. All these banks, companies, organizations, they're using high cash value whole life. So you might want to ask yourself the question, well, why? Why are the wealthy and banks and corporations and companies using high cash value whole life? Because frankly, there are individuals out there and folks out there and groups out there that would prefer you not learn about it. And we're talking more along the Wall Street lines, but it's been around for over 200 years. The wealthy use it, business owners use it, banks, corporations use it. So today we're going to discover, why do they use it? And we wanted to go through the social proof first to lay this foundation that it's very popular, as a matter of fact. And we're going to go through and look at 3 banks' balance sheets so you can see that what we're saying is actually true. And then you can go do your own study. So what we have here, this is the FDIC website, and we're going to look at Bank of America to start with. And this is their balance sheet through June of 2021. And if you come down to this line item, number 42, you'll see life insurance assets. They're carrying 24 billion. That's a B.
That's a B.
B, yeah, because these are in thousands. So it's 24 billion of cash value insurance. If we take a look at JP Morgan Chase, their balance sheet, life insurance assets, 12.1 billion. And then lastly, here's Wells Fargo, life insurance assets of 19.4 billion. And notice the year prior, it was 19.1 billion. So not only are they seeing gains in the life insurance assets, they're probably funding more premium into the assets as well.
Interesting.
So, yeah, real life FDIC statements. You can go Google these yourself. Social proof, so people can understand and listen to the webinar. There are a lot of people, businesses, banks, and corporations doing this. Wall Street would prefer you not learn about it. Why banks invest their safe and liquid reserves into permanent whole life insurance? They get a better growth rate. It's tax sheltered. It's liquid and accessible. Key person protection. And there are very high funding limits. There aren't restrictions like you have in traditional 401ks or IRAs.
So Barry, can you unpack that for a second? So they're using this strategically, correct? And they're using it because the benefits of life insurance or high cash value life insurance are unique. They're taking a portion of their assets, maybe as a safe bucket. Is that correct?
Yeah, tier 1 capital. It's safe for them. It's predictable. We're going to learn here in a minute of other benefits about guarantees. They can count on it. And because they're banks and they want to be safe for the most part, they store a large portion of their assets into high cash value insurance.
Well, yes. Could a small company, get similar benefits in utilizing high cash value whole life?
Yes. Matter of fact, we really like working with small companies and business owners so that they can get the same benefits too. You don't need to be a bank or a multi-billion-dollar organization to have these same benefits in your portfolio.
Okay. So diving in to the top 5 benefits of high cash value whole life, let's start with benefit number 1. Guaranteed investment. That's a power pack number 1. Barry, you want to reveal what that means for folks?
Yeah, thank you. A lot of people might say that a life insurance policy isn't an investment. The way we design it, it is more of an investment because there is cash value inside of a whole life policy and more cash value in these types of designs. I think it's better than an investment. We call it a guaranteed investment. We're going to look at an illustration here from one of the top companies that we do business with. And the way I've designed this illustration so people can see how the guarantees work and how a premium works. This is based on a 40-year-old, and he's putting $2,000 a month into a whole life policy. This is designed to lower the death benefit and to maximize the cash value, but there's a great growing death benefit as well. $2,000 a month at $24,000 a year. When that premium goes in, Steve, what's guaranteed? What is the insurance company really guaranteeing on the cash value growth? And you see here in this column, guaranteed cash value, that in year 1, there's over $21,000 of guaranteed money. Now, in a traditional whole life policy that may not be structured correctly for high cash value, you'd probably see a 0 there. But because we're using what's called a paid up additions rider, we're growing the cash value more rapidly. And notice every year that goes by, the cash value guarantee is always increasing. Doesn't matter which age we choose or how old the person is, the guarantees are always increasing. And the reason for that is a properly structured whole life policy has a guarantee and then it has a dividend. We're not including the dividends in this guaranteed column. This is simply the guarantee. What's like bare bones, worst case scenario.
Return on cash, basically.
The reason the guaranteed cash value isn't completely accurate, it's good to see, but it's not completely accurate because these companies that we use, they've all paid dividends for over 145 years. So the guaranteed cash value doesn't include the dividend. To show cash value without ever having a dividend, it's not realistic, but it is a worst case scenario. So people can say, yeah, this is guaranteed cash. I mean, here at 20 years in, they put in 477, guarantees 620. If you went off the dividend, that's a 703 number. Maybe it'll fall somewhere in between. Maybe it would be a little bit higher than 703, depends on the dividends that the company pays, but it is a fully guaranteed investment. You never have to worry about losing money, and you're growing money on a guaranteed, uninterrupted compound interest growth curve.
So Barry, that sounds like sleeping at night.
Yeah, peace of mind.
So, and I want to jump in on this because this is such a huge, important point for people to understand. And we talked a little bit before we kicked off here, just reading a book now, fantastic financial book called The Psychology of Money by Morgan Housel. And I'm not getting anything to plug the book, but what it talks about is making financial decisions that are reasonable, right? And then that's the key. A lot of people try to make financial decisions that are rational, right? Just by examining maybe numbers and things like that. And you could say that in this case that you're making a rational decision. But when you get it to the reasonableness test, this just explodes for me, Barry, because this is a reliable place that you're going to see growth in a world, frankly, of total uncertainty, correct? So absolutely. The other thing I want to point out is just that the numbers on the left there, those are years. So you can kind of see where your guarantee is after 5, 10, 15 years. That leads to predictable estate planning. And I know, Barry, you and I have talked a lot about predictability. We've done other webinars about paid up additions. And I hope that for those of you that are listening, that if this is the first time that you are able to dig into these concepts, I know Barry does, and I really want you to understand how these policies work. And what's really going on here is a very unique and powerful asset.
Agreed. I Googled some guaranteed rates yesterday. CDs, for example, the highest I could find was 1.25%, but you had to lock your money up for 5 years. Most CDs today are paying about 0.8%.
And there's no asset protection there either, Barry, right?
So that's right. And even those gains are taxable, where here we're talking tax-free, but you're going to earn much higher than a 1% return in these policies. Plus the dividend, on average, we can't speak for everyone, but on average, people are earning 5% net returns. Much better than a CD or a banking account, a savings account for sure. And this cash, Steve, is liquid. So if you put your money into a CD that's tied up or locked up for 5 years, that isn't the case here. You have access to 95% of this cash value in any year.
Yeah, and Barry, the other point comes to mind that you get wealth building success, not by doing all the right things. You can make mistakes, but the idea is to avoid screwing up as much as possible, right? So here, this is you really can't screw it up. It's a beautiful, predictable approach that applies the reasonableness standard, but also, frankly, is consistent year after year, which I know you talk about a lot when you talk about these returns. And we have another webinar on how these returns work over time and comparing to other kinds of returns. I know you do a lot of number crunching as well.
Yeah, your comment reminds me of what Warren Buffett has said about his 2 rules of investing. Rule number 1 is don't lose money. And rule number 2 is see rule number 1. Very serious about not losing money. So as you said, you could maybe do all the things right, but that doesn't mean the plan is always going to go right. There are a lot of people today that are taking those investments for retirement and putting them into 401ks and IRAs. Well, what if the market crashes 2 years before you retire and you lose 30% of your portfolio?
And ironically, Barry, I was just speaking to a client on my estate planning side of life today, and he confided that, he'd lost probably millions over the years in stocks, and there were some other changes in there too. In business, sometimes you have different things that happen, but definitely I've seen it with older clients in particular. So it's something to avoid.
And we're not saying don't ever invest in the market or don't ever have a 401k, but what we are saying is, and maybe we should ask the question, how much or what portion of your portfolio is truly guaranteed? And unfortunately, Steve, for most people, the answer is 0. So we're providing a way and a means to give those guarantees and even perhaps maybe outperform some of their stock market investments, as we'll see here shortly with additional illustrations.
All right, jumping into benefit number 2, legacy planning, one of my favorites. As an estate planner, I was chugging along in my trust and estate practice years ago when I was first exposed to the idea of high cash value life insurance. And of course, as a planner, I immediately resonated with it because it does a couple of things. One, it creates predictability, predictable wealth building, but it also takes care of loved ones. And then there's tax planning and asset protection around it. So you have this whole umbrella of things around it. And Barry, you mentioned a couple of things. You mentioned, what maybe Wall Street investment proponents want to question when they're in a different ballpark completely from what we're talking about here, right? If you're strictly trying to push financial products, you're not thinking about any of these things. And most people don't. So legacy planning is a huge part of this kind of planning. And I think it's exciting.
Yeah, and let's look at some real life numbers. We're using another illustration with another company, same 40-year-old, $2,000 a month example. And what we want to focus on now, since we're talking about legacy planning, is the death benefit. And you'll notice that this illustration for this person does have a growing death benefit. First year is $788,000. By the time they get to age 55, it's now $1.84 million. They only paid for a portion of that death benefit. What's great about this growing death benefit internally is there's very little cost to it because most of this premium is going into cash value, as we see here in this column. Focusing on death benefit, Steve, think about this. Most people out there are told to buy term insurance and invest the difference. The biggest problem with that is the term insurance is going to expire, usually when they retire. Let's say they get a 30-year term policy at the age of 35, they retire at 65, and maybe it was $1 million, $2, $3 million policy, maybe more. But now the term insurance is gone. They're still living, they're healthy, they've got longevity. What they could have paid pennies for the dollar for in death benefit, and I'm talking now permanent death benefit, not having any life insurance puts more pressure on their assets. Here's what I mean. Let's say that that same person has a net worth of $5 million and they pass away. They would have left the assets to their family with no life insurance, but that 5 million would have passed a straight 5 million. Those assets, retirement accounts, real estate, whatever the case might have been, really became their life insurance. Had they had a permanent policy, they could have actually spent and enjoyed more of their money while they were living because they knew that the permanent death benefit was going to come in and replace what they would have spent anyway. So what I find is a lot of people don't spend and enjoy their own money that they worked hard for because when the life insurance goes away, they're fearful. They want to leave a legacy, but they can't unless they don't spend their own money.
Yeah, Barry, and I'll just speak to the planning side. We're in a climate now where we might see some, or we're likely to see some changes in the estate tax exemption coming up in the next couple of years, if not sooner. And what that will do is if there's an estate tax on a fairly, modest size estate, it's going to create a need to pay those taxes within 9 months. So if there's no liquidity, guess what happens? Then they have to start selling assets off just to pay the estate taxes. It's important. Life insurance is commonly used in the planning world just to create liquidity in order to pay taxes and for other reasons too. So that's super important.
Yeah. And that person that does have a permanent whole life policy, it doesn't matter whether they pass away at 45 or 105. There's always legacy death benefit there for their family. I ran this particular illustration at $2,000 a month through the age of 65. But then I show at age 66, Steve, there's no more premium going in. Okay, so he's done funding, but look at the death benefit.
Yep.
It still grows. So we make an assumption he lives to 90, he passes away, he's going to leave his beneficiaries a $4.15 million death benefit, completely tax-free. He only put $600,000 into the policy, Steve. Talk about a return, but to your point of what you do as an estate attorney, this is, in my opinion, the most powerful legacy planning tool out there.
Yeah, and you're bringing up so many things, Barry, that I want to jump on, and I'm reflecting on recent conversations with clients. One of them was a sweet elderly client of mine. She has some different insurance policies. So she had, interesting, one of them was an IUL and the other one's a whole life. I said, well, I'm glad you have whole life because I'm not worried about it, right? I know that those premiums, if she's not paying the premiums, it's because it was paid up and there's no issues with that. I said, but you might want to have the IUL looked at. And we're certainly willing to help people with IULs at Insurance and Estates, but we're very clear about the purpose of it and how it's designed. But with these whole life policies, you just got so much reliability, and you have a secure death benefit, basically. The other factor is a lot of people are out there on the financial side, whatever the reasons, are talking about this buy term and invest the difference kind of thing. You're absolutely right, Barry. When the term expires, then they have no death benefit whatsoever. Now, think about that in a world where the estate tax exemption is potentially going down, down, down. You might have expired life insurance. I've seen them expire. I've seen they only pay up to a certain age sometimes, but I've seen them expire in the IUL side as well, or lapse. I just think you're getting so much reliability with these. The other thing people maybe need to realize, Barry, real quick, and I know you touched on it, the design, everything is in the design, right? And you're an expert at this of many years. And this involves a term blend sometimes to get the death benefit where you need it to be and add enough cash and still call it life insurance.
Correct.
Right? So sometimes that's missed too, that actually there's nothing wrong with term life, but a lot of times, this is designed so that the term can eventually drop off, correct? And so that the permanent death benefit can keep growing.
That's right. We want permanent protection. We don't want someone to get into retirement, lose millions of death benefit, and now consciously or subconsciously, they're concerned about either spending all their money or, oh my gosh, I can't leave the legacy that I wanted to leave to my children and grandchildren. Permanent life insurance solves that problem.
Jumping into benefit number 3, capital preservation. Barry mentioned Warren Buffett, don't lose money. Preserving your capital. It's very powerful when your capital is growing every single year for the next, whatever the term is on your policy. It simply doesn't happen with other assets, right, Bear?
We've both talked about these policies being an uncorrelated asset. There's no stock market risk. There's no loss of money. It's growing guaranteed every year. And again, having an uncorrelated asset in your portfolio would be a smart thing to do. You hear often financial advisors talking about diversification. Well, they'll share with you a diversified portfolio that's still 100% market-based, which isn't true diversification. True diversification would be different asset classes. This is an asset class that's different than the stock market.
Yep. This whole class of life insurance as an asset is pretty amazing from the standpoint that you've got state laws that give cash value asset protection, which is a nice little side benefit that we're not even talking about today, but it's certainly a huge aspect of this. When it comes to lawsuits, you got capital preservation right there.
Correct. Yeah. Even bankruptcy, Steve. That they're not going to go after your cash value. It's protected in most states from those issues. Well, let's look at another illustration to talk about capital preservation and what the real numbers look like. This is our same 40-year-old male, $2,000 a month. But what I did is I also added an additional $15,000 a year for 10 years. Here's the idea. What if this individual has money in the market, could be a brokerage account, an IRA, somewhere the money is volatile, and they're thinking, I really want to lock in my gains. I want to preserve the growth that I've had because I don't want to lose money. I don't want to go through a market crash. What can I do with the funds? So we're taking the same $2,000 a month, but adding a $15,000 lump sum in addition to that. In this scenario, we are going to look at the non-guaranteed values in this example, and here's why. The total cash value non-guaranteed, this does include the guaranteed value, but it also includes the dividend. The reason I want to look at the non-guaranteed values for this capital preservation example is because the companies that we use, they've paid dividends every year for over 145 years. We believe they'll continue to pay the dividend, but the dividend is not guaranteed. You still get the guarantee, but in addition to that, an annual dividend is paid. When we talk about capital preservation, Steve, a dividend once paid by an insurance company, it's locked in. So in year 5, when this company pays $4,200 of dividend and the cash value is $190,000, this person will never lose that $4,200 dividend. It begins to grow with compound interest as well. Now, compare that to a stock. If you have a dividend paying stock and you reinvest the dividend back into the stock and the stock goes down or loses value and you sell, you could lose the dividend. Yep. Not in a whole life policy. Once the dividend is paid, it's locked in. So not only is he preserving $2,000 a month plus the $15,000 that he's rolling out of a brokerage account or another investment, he's preserving every year. Once the dividend is paid, it's locked in as well.
That sounds like sleeping at night again, Barry.
Yes.
And it also sounds like true compounding, which we were just talking about. So you really have this power of true compounding.
And you see that every year that goes by, and we'll just choose some random years, like from year 9 to 10, the cash value total growth was 58,000, but only 39,000 went in. Year 20, cash value growth is from $1 million to 1.1 million. That's $78,000 worth of total gain on a $24,000 premium, Steve. And so we see these numbers increasing every year because of what you said. It is compounding. And not only is the interest compounding, but once the dividend is paid, now you're earning compound interest on that dividend too, because it's locked in.
That's so exciting. And Barry, one thing that comes to my mind right now is just based on research, the highest thing that most people want and why they want to make money is what? They want freedom to choose what they want to do with their time, and they want peace of mind, right? This is, it's such a nice facilitator of that. A lot of times, maybe there are other priorities that people have in mind that really aren't going to serve them when they're trying to do things that don't align with predictable gains like this.
Yeah, and you're bringing up something that's really important, kind of like the book, right? The Psychology of Money. We think about true wealth isn't just financial. Yes, financial wealth is important, but true wealth is holistic, spiritually, physically, mentally, emotionally, relationships. We want to be wealthy in all aspects of our life and have that balance. Mm-hmm. You, as I know, people that are wealthy that are miserable.
Yep.
Right. So we want true wealth holistically. And what you're describing is this type of planning, this type of policy gives someone peace of mind.
Yep.
And predictability. And when you have peace of mind and certainty in your plan in your life, frankly, you will be balanced in those other areas too, I believe, consciously and subconsciously, because you know this is going to do what it says it's going to do.
Right, Barry. Everybody needs that safe bucket, which ideally you have a safe bucket that you can draw from or use as leverage. So you and I talk in a lot of webinars about financial leverage or policy loans or these kind of things. So you've got a lot of different features there as well, just as an option, when you have this kind of planning.
There might be people listening to the webinar today that say, well, $2,000 a month, that's peanuts. I want to dump 10 grand a month into the policy. Great, you can. And then you would just 5X all the numbers here. But there might be some other people that say, well, 2 grand a month's just a little steep for me. Can I do 1,000? Sure. Cut the numbers in half. We design policies and plans specific to you. We want to meet your goals. We want to make sure that it makes financial sense. I will say this, the more money you put into a policy, the better future you're going to have. But also, you can go lower. This $24,000 or $2,000 a month premium has flexibility, Steve, to go as low as about $600 a month. And the person could choose to do that in any month. So it's a very wide range of flexibility. It's not something that you have to lock into the rest of your life.
Barry, if someone wants to put a lot of cash into a policy like this, the key is you have to have somebody skilled like yourself designing it so that you don't, what we call mech the policy. We've actually got a whole webinar on meching a policy. So in other words, they need somebody, most people can't march to their local agent, right? And say, hey, can you just do one of these policies up for me? Chances are that the person they're talking to is not going to have the ability to design this properly so that it does what they want it to do.
Correct. And we're going to get into that more right now.
Okay. Benefit number 4, banking and access to liquid cash. This is a great aspect because the infinite banking high cash value is premised on the availability of liquid cash, tax advantages, using these policies as a liquid asset.
For sure. Infinite banking is a uniquely designed, properly structured high cash value whole life policy with a participating dividend paying mutual or fraternal life insurance company. It's got to be whole life. And there's a lot out there on the internet about infinite banking. It isn't all true. Okay. Just know that some advisors claim to structure or sell infinite banking. It isn't always correct. The goal for an IBC policy, we want to lower the death benefit to keep your insurance costs down. There's got to be a term insurance rider there, and to grow high cash value. Those are the two main goals, as much cash value growth as possible. IBC is also known as Bank on Yourself. LIRP stands for Life Insurance Retirement Plan. Cash flow banking, a wealth maximization account, 770 account, or private family banking. And there's some other names too, but as you search infinite banking out there on the internet, you'll see other names, but you'll also see some things that aren't completely accurate. And not everyone's going to use their high cash value whole life policy for infinite banking. They're going to use it for the other benefits that we talked about as well. But knowing that they could, that's powerful. If they needed liquid cash for emergencies or an investment, down payment on a real estate deal, or whatever the case might be, the cash is there and available. Let's look at a real life illustration.
Can I jump in real quick, Barry? For you business owners out there, if you run a business, if you're a chiropractor, a medical person, if you own a manufacturing company or some other kind of business, think about our social proof at the beginning and how this could be used for just liquidity in your company. You can list it on your balance sheet. You don't have to go to a bank and have them, do high cost loans or run credit to get capital if needed. It's very flexible. Yeah.
Steve, we're going to use the same illustration we looked at prior for capital preservation, but we're going to focus here on cash value. And I'll say a few things. When it comes to infinite banking, our number one suggestion is when you take policy loans to buy other assets, cash flowing assets. Invest in real estate, invest into other investments that have great returns, invest back into your own business, right? Your business could be your highest rate of return. If you're leasing equipment or things that Steve mentioned, maybe you don't go out and lease the equipment. Maybe you take a policy loan and pay cash for it. Because when you take a policy loan from a properly structured whole life policy, the insurance company doesn't physically remove the money from your cash value. So let's say here in year 6, you need a $200,000 loan. They put a lien against the cash value, but your full $237,000 is still earning interest and dividends. There's no lost opportunity cost. And because you are your own bank, you get to pay the loan back how you want. A payment isn't required to be paid back. If you choose a 5-year amortization schedule or a 20-year amortization schedule, it really is up to you. And I help you with that. If you've got questions about how to pay the loans back, we consult and go through that together. But it's so powerful because you don't have to wait till you're 59 and a half to access money. You can take policy loans in the very first year of a policy. The money only needs to season 30 to 90 days, depending on which company we choose. But here we're talking about liquidity, using the policy as your own bank. And ultimately, when you do that, you're growing money in two places. If you go buy real estate with a policy loan, you've got the real estate and the cash flow from it. You also got the full cash value still working for you here in the policy. You're continuing to grow wealth in two locations. We call this the velocity of money. And you've got a death benefit, right? Which we've talked about for legacy planning. So many uses here, but the infinite banking is very powerful if done correctly. You might also be in a situation where you have some higher interest rate debts. Loans today are 5% through the insurance companies. So if you have balances out there with 7, 8, 12, 24% interest rates, well, yes, it would be smart to take policy loans to pay those off. But first and foremost, we like to advise take loans to buy other assets, cash flowing assets, or invest back into your business.
Yeah, great points. And one thing I'll just add, Barry, is that if people that are watching think of this as if you took a piece of real estate and you wanted to buy another piece and you had a bunch of equity in the real estate, you could take a line of credit against it and you could go and buy another piece of real estate. So it happens all the time with real estate investors. Any of you are listening. A couple of disadvantages to that are we've seen some high profile people over the years. I won't name any names, but had all of their loans called, right? And so they end up over leveraged on their property. The other issue with that is that you have to run through the credit approval process to get those loans on real estate, and rates are sometimes not so good. So this is far superior to trying to use other assets for leverage. So for any real estate investor out there, certainly makes sense to fund up this kind of a policy due to the availability of capital. And someone might say, well, I got all this cash, I don't really need that. And the whole point on that is you don't get the leverage then, right? Because in this example you gave, Barry, that cash is working even with the policy loan. So this is powerful stuff.
And if someone is sitting on cash, they're usually sitting on it in a savings account earning 0%. Yep. They would be much better off sitting on the cash here earning 4 to 5% tax-free and still have the liquidity. You call the insurance company up at their 800 number, they have a direct deposit to you for that loan within 3 to 7 business days. No credit check, no application, and they don't question you, what do you need the money for? It's very simple, it's very easy, because look, they know that if you pass away with an outstanding loan, they're simply going to deduct it from the death benefit. So if you have a $200,000 loan and you pass away the next year, instead of your family getting 1.9 million tax-free, they'll get 1.7, still a phenomenal legacy planning tool. And you got the loan within 3 to 7 business days. And there are a number of webinars on the Insurance and Estates website that are just specific to infinite banking. We'll spend 45 minutes only talking about infinite banking, where I go through more examples and even a policy loan, so you can see how policy loans work and you're still earning interest on your cash value. So if it's of an interest to you, check out the infinite banking webinars at insuranceandestates.com. Well, Steve, let's get into our final top 5 benefit of high cash value whole life insurance.
Tax advantage retirement income. We like to talk about the tax advantages, especially in this climate we're dealing with here. I'll just kick this off, Barry, by saying that, we're looking at potential changes to all across the board on taxes, capital gains, potential change in how S Corp income is taxed. So, this is huge. We've already seen major changes to IRAs in recent years. So it's great for somebody to have a essentially tax-free source of income. And I say that loosely, depending on how you do it. You certainly have that option with policy loans.
Steve, you're right. And think about this. If taxes do go up in the future, which they are likely to go up, most people today saving in IRAs and 401ks haven't paid tax on that money. They think they're getting a tax savings, which in 1 year, that's true. But what they're really doing is they're kicking the tax can down the road. And when they take money out of the IRAs and 401ks, it will be 100% taxable. It's a ticking time bomb that a lot of people don't really think about. If you've got $10 million in a 401k or $1 million, that isn't all your money. A lot of that, a good portion of it, is going to be eroded by taxation. So tax advantage, if done correctly, we can say you can take money out of these policies tax-free. Number one, we don't want to violate the MEC limit. 2, you do need to fund a policy for at least 7 years. And 3, you keep the policy in force until you pass away. That doesn't mean you pay a premium your entire life, but you do need to keep the policy itself in force. And if done correctly, you can take out tax-free retirement income. The Wall Street Journal called this the tax shelter of the rich. And all the benefits we're talking about with a properly structured whole life insurance policy meet that criteria. This is the tax shelter of the rich.
Yeah, just throw in there that, again, as a planner, I've seen it a lot where people run into the problems with not only liquidity, but also flexibility. Because if they get to a certain age, they have to take distributions on their retirement, on their IRAs or 401ks. And for some, that pushes them into a higher tax bracket. The nice thing is you've got tax-free income potential, but you don't have to take it, right? Have you had experiences with that?
Yeah, that's absolutely correct. And not only that, there are no funding limits. So someone could put in as much as they want into these policies. Theoretically speaking, there are some guidelines that the insurance companies have, but they are not forced to take money out with RMDs at age 73. It could keep them in a lower tax bracket if they choose to not take as much money out of, say, their brokerage accounts or qualified accounts. They can take more money out of this and potentially be in a lower tax bracket in retirement, but living off the same amount of income or perhaps even more, because the money coming here that we're going to see in a minute is coming to them tax-free.
Nice.
All right, let's look at a real life example. Steve, we're using our same 40-year-old male, putting in $2,000 a month plus the $15,000 for 10 years. And we're now going to look at income. This is tax-free income. Well, how does it work? When someone chooses, I'm ready now to start taking income, what's that process? What we're doing is we're showing him funding that $2,000 a month through the age of 65. And then at age 66, he's going to put in the minimum of $9,000. And at age 67, the minimum of $9,000. And at age 68, he calls me up and says, Barry, I want to start taking income. I don't want to fund the policy any longer. I want to be done. At age 68, the total premium is zero. He's not putting any more money into the policy. He has a total $1.64 million of cash value, and he wants to take the maximum amount out from age 68 to age 90, which is $107,000. So here's what he does. He calls the insurance company and says, please start sending me a check every month. We take the 107 divided by 12 for $8,900. Just do a direct deposit into my bank account for $8,900. And he could take 107 every year if he wanted to, but most people want monthly income. What they're going to do is they're going to first take the $107,000 out as a withdrawal. They're going to withdraw up to the $750,000 that he put in. Because it's money he already paid tax on, he doesn't have to pay tax on the withdrawal coming out. Once that's exhausted, we call that his basis. Then they start doing policy loans. The 107 still comes out, but now there is a loan balance accruing. In retirement, Steve, he doesn't pay the loans back. The loans are going to come off of the death benefit that we talked about. Not only is he stopping the premium, but he's also not paying loans back. Now, if we take $107,000 from age 68 to age 90, which is 23 years, and we look at how much he was able to pull out, $2.46 million, and he put in $750,000. Look at the 30,000 foot view here. He puts in $750,000. He had death benefit protection all through his life, millions of dollars of death benefit protection and legacy planning. He's pulling out $2.46 million through the age of 90, completely tax-free, which, by the way, depending on his tax bracket, is going to spend more like $3 million taxable. And if he does pass away at age 90, he's still going to leave a $580,000 tax-free death benefit to his beneficiaries.
For folks that are listening and want to see this illustrated for themselves, you're basically doing this all day long, correct? So you could crunch numbers with anybody had questions of how they're given their life, health, and all that stuff, how this might work for them.
Yeah. And when someone sees their own numbers, it becomes real. I do encourage people, look at your own numbers, determine what you feel is a great premium for you. If you want to do any overfunding in the first year or additional years, we can include those lump sum amounts. It's got to make financial sense for you, obviously. But again, the more money you put in, the better future you're going to have. And yes, let's begin to look at your own numbers.
Right. And when I see this, Barry, I think about continuous compounding making it possible, right? Because you have this exponential growth that kicks in after a few years, and it just gets really exciting. And it matches my personal experience with a lot of people that love their policies. It's their most valuable asset for all of these reasons.
Yeah. And when you consider this from an estate attorney's perspective, what if there's a premature death? What if they pass away at 70? Well, they would have pulled out $107,000 for 3 years, but their family still gets a $2.8 million death benefit. It checks all the boxes, Steve. And that's what we want people to understand. The misconceptions that are out there from the financial entertainers that we call them, they're so misinformed. And unfortunately, they're doing more misinforming because they're sharing inaccurate information. We want people to be clear that whole life insurance, when properly structured, is perhaps one of the best, if not the best, planning tools that you could ever have in your portfolio. And that's why we started with the social proof. The banks, the corporations, the wealthy, whole life insurance has been around and used by all those for over 200 years. You have an opportunity now to get all these same top 5 benefits in your own portfolio.
Exciting.
So, Steve, as we recap, top 5 benefits of high cash value whole life insurance: it's guaranteed, it's tax advantaged, capital preservation, legacy planning, banking, access to liquid cash. There are other benefits too, but these are the top 5 that we want people to recognize that they can have in their portfolio.
Very good. Well, that was exciting. The next step really for you, if you've come this far, if your interest is ready to explore specific options, you can click the button below this webinar. There'll be a short few questions there, and you can schedule a private consultation with Barry to go over things in detail. And we invite you and encourage you to do that. And again, we thank you for joining us today. We appreciate it.